Thank you very much, and sorry to give the organizers here a scare. My name is Aaron Kellner. I'm a principal at SeedInvest, the largest equity crowdfunding platform in the US, which has funded over 150 companies since our inception about 4 years ago. Admittedly, we're going to be taking a little step off of the crypto path for a few minutes here, but I do promise that we will be bringing it back, or I will be bringing it back by the end. Over the next 10-15 minutes here, we'll be talking a bit about the Jobs Act, basically the regulatory framework that enabled crowdfunding, equity crowdfunding in the US, also regulations that will become of increasing interest to issuers interested in conducting token sales. We'll be talking about SeedInvest ourselves a little bit, and then, like I said, we'll be tying it back to the crypto space for a hot second at the end. So in terms of kind of our background, our inception, why we do what we do, it's kind of a simple answer. Fundraising sucks. It is a miserable, time-consuming experience for almost every single startup founder. Basically, the worst part about founding a company. Up until really only about 2 years ago, the security laws, the framework through which private companies could raise money, literally hadn't changed since the Securities Acts of 33 and 34 were passed in the wake of the Great Depression. Basically, if I'm a founder looking to raise money, I can approach individuals or entities with whom I have a pre-existing relationship in order to solicit investments. Provided those investors are accredited, I can accept investments from them. That's it. Everything else would technically be a violation of security laws. So we helped change that. We were involved in the passage of what ultimately became the Jobs Act, originally known as the Entrepreneurs Access to Capital Act, which was passed in April of 2012, but has slowly come online over the last 4 to 5 years. And basically, what the Jobs Act did, it's an acronym for Jumpstart Our Business Startups Act, a piece of legislation essentially designed to stimulate economic growth by making it easier for entrepreneurs to access capital. This was broken down into a number of titles. Some of them were actually more applicable to companies looking to ramp up onto, let's say, the NYSE or NASDAQ, but a number of the titles were specific to early stage capital formation. So the Jobs Act, like I mentioned, kind of was broken down into a number of titles, essentially kind of came on in waves, on average about 1 per year from 2012 to 2016. What the Jobs Act did initially was enable private companies to engage in general solicitation, to publicly advertise the fact that they are engaged in a fundraise, but still only being able to accept investments from accredited investors. The more significant change happened when in 2015, when what is known as Title IV of the Jobs Act went into effect, basically bringing online what are known as Reg A+ offerings. In 2016 followed with Title III of the Jobs Act coming online, bringing about Reg CF offerings. I'll go through all of these in a little bit more detail in a hot second here, but basically why these new regulations were so significant is because quite literally for the first time in about 100 years, a startup founder, a private company could both publicly advertise the fact that they were engaged in a fundraise as well as be able to accept investments from anyone that wanted to invest in their company. So we helped get those laws passed back in 2012. We ourselves set up shop. A few months later, it kind of trickled into 2013. But basically, the gist of what we tried to build and what we have built is a system to essentially make investing in startup companies as easy as buying a share of publicly traded stock. Again, I'll get into this in a minute or two, but we've taken a little bit of a differentiated approach since the get-go, operating through a regulated broker-dealer, conducting independent due diligence on every company before potentially making them available to our investor network, basically just providing a bit more of a curated deal flow for those in our network. We are a two-sided marketplace, and at the end of the day, while we do take pride in democratizing access to this asset class for investors regardless of accreditation status, geographic location, so on and so forth, at the end of the day, SeedInvest was founded to help entrepreneurs. We at SeedInvest, the founding team, know firsthand the trials and tribulations associated with raising capital, and this was a problem that we wanted to help solve. And with all of these regulations now online, what we do kind of at our core at this point is provide the issuers with whom we work, that we partner with, that we invest in, more options in terms of successfully completing fundraisers, successfully attracting capital to their businesses. Because we operate through a regulated broker-dealer, we're kind of, I think of us kind of like a full stack platform facilitating every type of offering exemption currently available to early stage founders. Reg CF and Reg A+, like I just mentioned, are the most recent to come online. Opening up, fully and finally opening up this asset class for all investors. Regulation D, for those of you who may already know or don't know, that's basically your run-of-the-mill traditional private placement, basically the way that companies have been raising money for the better part of the last 100 years. So, like I mentioned, 506C under the Reg D offering exemption, that was the kind of first somewhat notable piece of the Jobs Act to come online. Again, for the first time, this allowed companies to advertise the fact that they were engaged in a fundraise. This doesn't necessarily just mean like literally throwing up banner ads and this, that, and the other thing, but even just having a, invest bar on the top of a company's own homepage, being able to reach out to their customers, their users, and inviting them the opportunity to be part of the growth of the company. Again, you could only be an accredited investor for companies conducting raises under this offering exemption, but still a pretty big milestone nonetheless. But we're biased, so take it with a grain of salt. Reg CF is an offering exemption, again, open to all investors. The kind of long and short of a Reg CF is it enables companies to raise up to $1.07 million over a rolling 12-month period. In order to do so, there is a filing that needs to be made with the SEC. They also have to get, for first-time issuers, their last 2 years of financials reviewed by an independent accountant, but a fairly streamlined and not that expensive process, depending on who you work with to do it. We can basically take a company from being interested in conducting this type of raise to live and accepting investments in as little as about 20 days. So even with the kind of prospect of needing to make a little filing with the SEC and getting your financials reviewed, as long as companies have their house in order, really not too big of a deal. Reg A+ is a bit more interesting, and this is actually the one that's going to be a bit more interesting for the end of the presentation here. Reg A+s are kind of informally known or dubbed as mini IPOs. Through a Reg A+, a company can raise up to $50 million from accredited, non-accredited investors. In order to do so, they do need to get their last 2 years of financials fully audited by an independent accountant. Also need to have their offering actually qualified by the SEC and FINRA in a process that is similar to, albeit a skinny down version of what we would think of as a more traditional IPO process. This is still a lot more streamlined, relatively speaking, to that process. A company can, again, provided it has its ducks in a row, get from being interested in conducting a Reg A+ to launching and accepting investments under that in about 2.5 to 3 months at a cost of maybe $50,000 to $75,000 all in. The reason why this is specifically interesting, especially for the crypto space, those that want to issue tokens and have them be freely tradable, is that as opposed to an offering conducted under the Reg D offering exemption, as opposed to a offering conducted under Reg CF, because the SEC has qualified a Reg A+ offering, it means the shares or the securities that are issued through that Reg A+ are freely and immediately tradable, which is interesting. There are companies that are increasingly using Reg A+ to uplist their shares onto the OTC, some of the NASDAQ subdomains, which is a trend that we see going forward. Again, take it with a grain of salt. We're biased, but in our opinion, there is almost no reason for private companies to go conduct a more traditional IPO in the future, considering that a Reg A+ basically gets them to the same point, takes a couple or a few months versus a year plus, and costs $50,000 to $75,000 as opposed to $1 to $2 million, if not more. So definitely seeing a lot more activity with these guys. At its core, though, there is also the kind of like these biases, if you will, against these types of offering exemptions or these types of offerings. and in truth, there's the, kind of the, okay, well, if this is such a good company, why would a VC just take it down, a family office, this, that, and the other thing? What we find is that there actually are tangible and impactful benefits to companies that are engaging in these types of offerings. Obviously, those that are conducting ICOs, token sales, et cetera, kind of are already in a like mind as we are. We view what is going on in the ICO space as a very, very related adjacent to what we've been doing in equity crowdfunding over the last half a decade. And these are actually what we find to be, again, fairly interesting statistics. These are actually drawn not even from private companies, just from public companies, of just when someone owns a piece of a company, they talk about it more, they visit the website more, they spend more money on that company's goods and services. We have found very similar patterns of behavior for companies in our portfolio that basically will come back and raise through us again and again, specifically because of the changes in behavior that they're seeing among their customers, among the users, among investors that participated in their raises. It is also not antithetical to a traditional fundraising model. Part of this is admittedly a function of our specific approach to equity crowdfunding, taking a highly vetted approach to what we do, only listing and working with a very, very small percentage of companies that elect to work with us. But we work alongside VCs, institutional investors, quite frequently. These are all funds, for example, that have either co-invested or that have either led, followed, or co-invested in one of our portfolio companies. As I've alluded to, a couple times, we do take a little bit of a different approach to doing what we're doing. This is a bet that we made half a decade ago about the specific nuances of the asset class that we are engaged in. That while we are a marketplace, at the end of the day, that we are not really interested in being a Craigslist, being kind of just like open to everybody. That we do want to take that highly vetted approach to doing what we're doing. And so far, it's been working out fairly well. We have established what is the largest equity crowdfunding platform in the US. We do dominate marketing share. We have the largest investor base, most inbound deal flow. And again, our investor base is not just these couple 100,000. It's actually probably more like a quarter million at this point. Retail investors, but an established network of accredited angels, family offices, VCs, corporate venture arms, and so on and so forth. We basically like to operate at scale, as opposed to venture funds that are looking to make a handful of investments, potentially a year, a quarter. We're typically funding somewhere between 5 and 10 companies a month at this point. We usually have somewhere between 1,500 and 2,000 companies applying to work with us, get exposure to our investor network on a monthly basis. And so we've kind of had to develop systems to kind of scale this type of diligence at the levels at which we operate. For context, over the last 4.5 years, give or take, we've now had in excess of 25,000 companies that have applied to list on SeedInvest, gain exposure to our investor network. Of those 25,000, we've so far approved a little bit less than 1%. So when I say we're picky, we do tend to be picky. And so far, that has been really helpful for our investors. This is the essentially aggregate platform return for the last 5 years compared against similarly vintaged VC funds that were basically launched the same time that we were. As is evident, we are doing a bit better than the industry median. The other nice boon for investors in our network is we also don't take carried interest management fees or anything like that. All of the returns earned by our investors are 100% theirs. So like I mentioned, I'm going to be tying this back. And like I said, we do view token sales, ICOs, as being very adjacent and very related to what we're doing at the end of the day. Both equity crowdfunding and ICOs are about democratizing access to these type to investors and to investment opportunities. And the problem as we see it, we admittedly have not facilitated a token sale on our platform thus far. Not anti it per se, just haven't really come across one that we're comfortable lending our brand and credibility to. And really in, kind of the past couple years, as the space has heated up quite dramatically, the problem as we see it isn't necessarily what is going on, more so the fact that almost every ICO that has been conducted in violation of security laws. And that's going to be a problem for the people who sold those tokens. There is this kind of predominant notion, or at least has been, that the SEC and FINRA are regulators from whom it is better to ask for forgiveness than permission. And that is very much not the case and very much not how they operate. If you do something that is deemed illegal, they will come after you, regardless of how long ago you did it. Fortunately, though, there are a whole set of security regulations that have been set that those who wish to issue tokens can conduct those sales through. And as I kind of alluded to earlier, Reg A+ really seems to be the silver bullet for those that are interested in doing so. You can raise from anybody you want. You can advertise the fact that you are doing it. You can raise a fairly substantial amount of capital while also conducting this in conjunction with any other type of offering exemption that you want. The states are preempted from the primary offering. The shares, the securities, whatever is being sold are freely tradable thereafter. And we actually just got word from the state regulators within the past couple weeks as a really nice development, because all of these, there are a different set of regulations that one needs to comply with when you're doing a primary offering versus secondary offering. So even if a company sold tokens under, up until this news, let's say, under Reg A+, and were fully compliant, once those shares became fully tradable, then you need to start going back to each state and actually getting their blessing to have those securities traded by residents of those states. The feedback that we actually just got, or that for companies that are conducting, or even for tokens that are sold or securities sold under Reg A+, under Tier 2 specifically of Reg A+, that the states for those are also going to walk back any type of reporting or filing with them for the secondaries as well. So it actually just makes it even more attractive and even more viable option. So I am out of time, actually only a minute over, which is pretty good for me. I ran through all of this extremely quickly, I know. I'm probably sure I missed a bunch as well. I'll be hanging out back if anybody has any questions or anything that I can clarify. But thank you very much for your time.
Hey, while you're up there, happy to field a few questions while you're in front of the audience, if there's any.
From those that we've seen, not really. That doesn't mean they don't exist. We tend to focus a lot more just in terms of our analysis and what we're looking to do in the near term on security tokens, admittedly. For utility, it's something that we're going to turn a little bit more attention to, probably in Q1 of next year, but it's just not the immediate focus for us, admittedly. Yeah, exactly. It's funny. One of the most difficult questions I'm ever asked is like, give me like a broad stroke overview of what your investor network looks like, because it really is quite a heterogeneous bunch. I mean, honestly, whether retail investor or accredited, we've got folk in our network that aren't interested in putting more than $1,000 into any specific opportunity. We've got those that wouldn't write a check less than 10 or 20 million. So it really kind of does run the gamut. But to your point, yeah, things like pensions and stuff is just at a level that is it's difficult for them to get into, one, because we tend to focus on C to Series B, so kind of raises maybe $500,000 up to 20 million. There's just not a lot of room for those types of checks to get into those rounds. The lack of liquidity is also something, especially for companies at the stage, that they have difficulty getting comfortable with.
Other questions? Okay, well, I got one for you. Let's say hypothetically I ran a fintech incubator program. That would be the best way that I could work with you guys.
So the best way would be to shoot me an email. I can get you hooked up with our venture team to kind of talk through exactly what we do, how we do it, what would be required of you. Would also get started on the diligence front, and then we can take it from there.
Perfect. Well, thank you so much, Aaron.
Thanks.